morning, good afternoon, good night from wherever you're joining us. Welcome to this webinar, State of the Art in Credit Risk Modeling. My name is Bart Baesens, and I will be your host today in this webinar. First, a little bit of information about myself. I'm connected to the Department of Decision Sciences and Information Management at the KU Leuven in Belgium. The KU Leuven is one of the best universities in Belgium, and that happens to be the university where I work, and it's situated in Leuven. Leuven, which is quite close to Brussels. It's about 20 miles away from Brussels. Everything's close in Belgium. It's a small country, you know. Leuven is well known for a couple of things. It's obviously known for its university, as I just came to say, but also for other things that Belgium is known for, more specifically beer. Some of you may have heard of the beer Stella Artois, which is a beer which is being brewed in Leuven. If you look at the name tag on the bottle, you will see brewed in Leuven. Stella Artois is not the best Belgian beer, though. I always say that most of the Belgians don't like it, and that's the reason why we export it. We have other good beers like Trappist beers and so on. Unfortunately, this webinar is not about beers, but it's about credit risk modeling. So in what follows, I'll give you an overview of the state of the art in credit risk modeling based upon my own industry and consulting experience. Here you can see some further information about myself in case you'd be interested. So I studied at the KU Leuven in Belgium. My master's degree was in business engineering and management information systems. After that, I obtained my PhD in applied economic sciences. The title of my PhD was Developing Intelligent Systems for Credit Scoring Using Machine Learning Techniques. You can find my PhD for free. You can actually download the PDF from my website, www.dataminingapps.com. So on my website, you will find our different research tracks. We're doing quite some research in credit risk modeling, but also in other related fields like marketing analytics, fraud detection, and so on. We also have a newsletter, so in case you would be interested in our newsletter, you can also subscribe on dataminingapps.com, and you'll get 2 weekly updates about our ongoing research projects, interesting events, interesting websites, and so on. I recently also wrote 2 books. One of them is on analytics in a big data world, which kind of looks at the analytics process model, starting from data pre-processing to data mining to post-processing. And then my most recent book is on fraud analytics. In case you'd be interested, you can find more detail about both books on www.amazon.com, where you can also get them from. Okay, so what are we going to do today? Today we're going to do 2 things. I'm going to give you an overview of some of our research findings in credit risk modelings, which are largely based upon industry collaborations we had with major financial institutions worldwide. Next thing I will do in this very short webinar is I'll guide you through an e-learning course, a self-paced e-learning course, which I recently developed and which zooms into more detail into each of the topics that I will cover in this webinar. So my e-learning course basically consists of a set of videos that clarify all of the concepts related to credit risk modeling, credit risk validation, and stress testing. But before we get into the e-learning course, let's first start with some general challenges in credit risk modeling. We're going to start with a brief introduction, which will situate the importance of credit risk modeling in today's industry. Then we'll zoom into data quality. Data is the key ingredient of any analytical model, so it's really very important that your data is of excellent quality. Then we'll get into model requirements. If you're building credit risk models, what are the requirements in order to have good credit risk models? A good credit risk model should satisfy various requirements. We're going to extensively zoom into this. Then we'll make a distinction between model discrimination and model calibration. This is a distinction which is very important in credit risk modeling, and the importance of it has been further amplified by means of the recently introduced Basel II, Basel III capital accords. Finally, we will end with some closing remarks about model validation. Obviously, I cannot cover everything into big detail given the limited time span and given that these topics are also quite extensive to cover. Let's start with the introduction. Well, more than ever before, analytical models steer strategic decisions of financial institutions. Undoubtedly, you have heard of the term big data and analytics. Now, big data and analytics is very important for banks, financial institutions, and so on, because banks are going to use those new emerging technologies to build credit risk models, which are going to evaluate credit risk in terms of default risk, in terms of loss risk, in terms of exposure risk, but also to set up market risk models, which are going to evaluate market risk by looking at exchange rate risk, commodity price risk, interest rate risk, etc. Also operational risk models, think about fraud risk models and so on. Now all these models will nowadays be built using big data originating from a variety of different sources combined with analytics. And the outcome of those analytical models will then directly be used to quantify the expected and unexpected losses a financial institution is likely to face. Those expected and unexpected losses will then in turn lead to provisions or equity buffers which banks should set aside in order to sufficiently protect themselves and even more importantly, protect their savings depositors. So analytics is very important, and given this importance of analytics to financial institutions, to savings depositors, and as such to society as a whole, we see more and more regulation that has been introduced to steer the development of those analytical models. Obviously, you have heard of the Basel I, Basel II, Basel III Capital Accord. In essence, these Basel Accords are purely analytical models. They specify the inputs of an analytical model and they specify the output of an analytical model. They also provide well-defined guidelines about how the analytical model should be built. What are the characteristics of the analytical model? Basel I, II, and III, or analytical accords, focused on credit risk models. Solvency II and the Solvency Accords, or analytical accords, focused at insurance risk analytical models. So these accords basically are very important, since model errors, that means model deficiencies, will directly affect the profitability, solvency, shareholder value, and macroeconomy, and as such, society as a whole. The impact of analytical model errors is now bigger than ever before. That's why it is so important to make sure that your credit risk models are built in an optimal way. Now, if you look at the Basel Accords, what they are basically doing is decomposing credit risk into various dimensions. The first dimension is a default dimension which will be quantified using the probability of default, or PD. Look at this term very carefully. It's a probability of default, or PD. It's not a score. It's not a bureau score, because a bureau score, as it's provided by Creditinfo and other types of parties, can be any number. It can be a number between 300 and 800, between 0 and 1,000. We're not after scores right here, but we're after probabilities of default. A probability is always bounded between 0 and 1. So it's a probability of default. So probability of default gives you the likelihood that an obligor is likely to go into default in the upcoming 1 year, expressed as a number between 0 and 1. It's a probability. That's really very important. So that's the first very important component. The second very important component is the exposure at default. For on-balance sheet items like installment loans, mortgage loans, etc., this is just the nominal outstanding balance at the time of capital calculation. So if I started off with a mortgage of 250,000 euros and today I still owe 50,000 euros to the bank, then my exposure at default is 50,000 euros. It's the amount outstanding. It's usually expressed as a currency. Note, as a side remark, that for off-balance sheet items like credit cards, revolving credit lines, home equity lines of credit, or HELOCs, exposure at default is usually expressed using a credit conversion factor, or CCF. A credit conversion factor, or CCF, represents how much of the unused credit is likely to be converted into credit upon default. But this is only for off-balance sheet items. For on-balance sheet items, we just look at the amount outstanding. The loss given default, or LGD as it is abbreviated, is again expressed as a decimal, and it represents the ratio of the loss on an exposure due to default of a counterparty to the amount outstanding. So if the LGD would be 50% and the EAD would be 100,000 euros, then I would anticipate to lose 50,000 euros upon default. So LGD times EAD gives you the absolute amount that you anticipate to lose upon default of the obligor. Obviously, this amount will only be lost upon default. So if we multiply LGD times EAD with a PD, we get the expected loss. The expected loss gives me the average loss upon default. Very important to note is the term expected. It's average loss. That means that it will be characterized by volatility. And this volatility is captured by the unexpected loss. The unexpected loss is a function of the PD, LGD, and EAD, whereby we typically make some distributional assumptions. I cannot elaborate on these distributional assumptions in this 1-hour seminar, but usually financial institutions will adopt a VAR approach, a value at risk approach. And here you can see a loss distribution in the lower right corner of my slide, whereby the PD represents the expected loss. And remember, in the Basel Accord, expected loss should be covered by provisions, which is part of the P&L statement you set aside for future bad things to occur. But the unexpected loss represents the volatility around the PD, and that should be covered by capital. The Basel Accord provides a very precise formula to actually connect the PD, LGD, and EAD into unexpected loss. In my e-learning course, and basically also when I talk to banks and when I do research, I'd like to always come up with a 3-layer credit risk model architecture. Level 0 or layer 0 is the data. This reflects internal data, transactional data, data which you have gathered internally. What's also very useful is external data, data that you obtain from credit bureaus or credit reference agencies like Creditinfo, who is hosting this seminar with us. Also, expert judgment. Expert judgment refers to qualitative data, expert knowledge. This is usually very valuable knowledge to help you steer and validate your analytical models. All this data will then feed up to level 1. In level 1, we will start building our first model. If we're looking at PD models, remember PD stands for probability of default, then we're looking at application and behavioral scorecards. An application scorecard is a scorecard which is going to assign credit scores at the moment of application. So as soon as I apply for a mortgage, an application scorecard will give me an application score. A behavioral scorecard is the next type of scorecard which is going to score your current obligors, your current set of obligors. So it looks at all the ones that are in your portfolio at this very moment, let's say at all your mortgage customers, and then looks at their behavior and calculates the probability that they're going to go into default in the next 1 year. Those application and behavioral scorecards come up with scores, and a score can be any number. It can even be negative. It could be bounded between 0 and 1,000, between 300 and 850. It could be any number. So that's why we need the second level where we're going to define ratings. A rating is a grouping of obligors which are similar in terms of default risk. That could be a segment, that could be a pool, that could be anything. A rating represents a segment of obligors which are homogeneous. For every rating or segment, we will then calibrate a PD. We will calibrate a probability of default. Probability is a number between 0 and 1, which reflects the likelihood that an obligor is going to go into default in the upcoming 1 year. These are the 3 levels of credit risk model development. We will use those levels for various purposes. We will use them to develop the models. We will use them to validate the models, more specifically to backtest and benchmark the models, and we will use them to stress test the models. In my e-learning course, I extensively zoom into those 3 levels and illustrate how you can do all those activities across those different levels for PD, LGD, and EAD. Now, if we zoom into PD for a moment, here you can see application and behavioral credit scoring, which we already referred to before. Remember, application scoring gives you a score upon applying, upon the moment of credit application, whereas behavioral credit scoring is part of ongoing risk monitoring. Usually, they have between 10 to 15 variables, independent variables or characteristics. In application scoring, you can think of variables such as the age of the applicant. You can think of variables such as the income of the applicant, employment status of the applicant, marital status, etc. And if you look at the performances of those models, you can see that the AUC is a key performance metric for PD modeling, stands for area under the receiver operating characteristic curve. It's a number between 0 and 100%. And the closer it gets to 100%, the better the performance of the model. Basically, you can see here that behavioral scoring models perform better than application scoring models. Well, that's quite obvious because behavioral scoring models start from more data than application scoring models. But the thing worth noting is that both application and behavioral credit scoring models usually perform really good. Right? If you look at those AUC values, those are not that bad if you compare it to other settings. Here, I've also included some performance benchmarks from other types of settings in which we have been working, like insurance fraud detection and churn detection in telco. But the key message to remember from this slide is that application and behavioral credit scoring models, which are 2 models for PD modeling, usually perform quite well. However, you have to be aware that even despite the fact that those models perform quite well, we are always looking to further perfection them. We're always looking to actually further boost the performance because even a small boost in model performance can imply significant gains in terms of profit or reduced cost. So if you want to further perfection in an analytical model, there are 2 strategies that you can adopt. The first one is that you work on the modeling technique. Most credit scoring models that are used in the industry nowadays are very simple models based upon regression approaches such as linear regression, logistic regression, decision trees, or even regression trees. So we could use more complex modeling techniques like you may have heard of neural networks, support vector machines, and random forests. Especially the latter technique, random forest, is a very powerful technique to actually build high-performing analytical models. Despite the fact that those models are so well-performing, because they typically benefit from a universal approximation property, you basically end up with very opaque black box models if you use them. You will lose interpretability of your models. And that's not a good thing, because especially in credit risk modeling, if you're rejecting a particular client, the client is entitled to knowing why you are rejecting him or her. So having explanatory facilities are very important in credit risk modeling. This basically prohibits the use of those complex modeling techniques like neural networks, SVMs, and random forest. So another way that we can use, another strategy that we can use to boost the performance of our models is by working on their key ingredient. Key ingredient of an analytical model is data. Internal data, external data, and so on. So we could try to enrich our data, improve the data quality of our internal data, or maybe even consider purchasing some external data from a credit bureau. The advantage of doing this is that we can still rely on our simple models, so our models will still remain interpretable. The disadvantage is that we will need additional investments, especially in terms of ICT resources. Data quality is a very important concept, especially given the GIGO principle that states garbage in, garbage out, or messy data gives messy models. Throughout our research, we have consistently found that simple analytical models such as linear regression, logistic regression, and decision trees perform consistently well in various settings. So the biggest performance increase to come up with high-performing analytical models comes from the data. Hence, the importance of master data management and data quality programs. As I always say, the best way to improve the performance of an analytical model is not in the first place to look for fancy tools or techniques like neural networks, SVMs, or random forests, but to improve data quality first. Now, data quality is a very vague concept. It's a very vague term. So if we want to work on it, we need to have a better idea of what data quality is actually all about. And I have one PhD student that worked on data quality before. You can think of data quality as being decomposed out of data accuracy. Data accuracy is a very important data quality dimension, right? Data completeness, to what extent are missing values important? Are we being confronted with missing values, yes or no? Data bias and sampling. As soon as you start working on a particular sample, you always have some bias because the sample was drawn during a particular time frame, assuming a particular strategy of the firm, assuming a particular portfolio composition, and so on. So data bias is always an issue, but it's very important that you are aware of the bias that's in your data, such that you can appropriately understand the findings that come out of your analytical models. Data definition, data recency, and latency. These are just a few examples of data quality criteria or dimensions that should be carefully looked at when you want to improve your data. Here you can see some other data quality criteria, and I'm not going to go through them extensively, but it was based upon PhD research of my PhD student, Helen Moggs, who looked at intrinsic data quality criteria such as accuracy, objectivity, reputation, contextual data quality criteria, representation data quality criteria, and access-based data quality criteria. In this research, we also conducted a survey of more than 50 banks worldwide, whereby we focused on credit risk analytics. And most of the banks that participated indicated that between 10 to 20% of the data suffer from data quality problems. This is quite a lot if you realize that this is the data that is being used to build analytical models, which are in turn being used to quantify unexpected and expected losses, which are in turn being used to quantify the buffer capital. Manual data entry was considered to be one of the key problems, together with the diversity of data sources and a consistent corporate-wide data representation. If we ask firms why they invested in data quality, we always got the answer because of the regulatory compliance, because of the Basel Accords that basically enforce us to invest in data quality. Data quality is a very tricky issue because you can complain about it in the short term, but there's not like a magic silver bullet solution which is going to remedy your data quality problems like that. So in the short term, if you are faced with poor data quality, you have to deal with it in a statistical way. In my e-learning course, for example, we discussed various ways of doing that, using truncation procedures, using missing value imputation procedures, using outlier handling procedures, using coarse classification procedures, etc. If the problem is really bad and you cannot get it solved in a statistical way using any of those procedures, you may have to resort to external data as it is provided by data poolers in order to start building your first internal credit risk models. Obviously, this is just a short-term solution, and in the long term, you should think about carefully redesigning your data entry processes and set up programs for master data management such that you can guarantee that you have a high-quality internal data set that you collect in order to build better credit risk models. Now, talking about those credit risk models, and now we're basically moving up one level in that multi-level model architecture that I introduced before. Remember, level one was the Level 0 was the data, level 1 was the model, level 2 were the ratings and the calibration. Well, if we move up to level 1, if we dare look at what are the requirements of a good analytical PD, LGD, or EAD model? Well, first of all, a good analytical PD, LGD, or EAD model should have excellent statistical performance. It should actually be meaningful in statistical sense. PD models should have high lift curves, high ROC values, etc. LGD models, which have continuous targets, should have high R squared or MSE, mean squared error, should have high R squared values or low mean squared errors. Besides statistical performance, interpretability and justifiability is also very important. Given the usage that is being made of credit risk models, not only for capital calculation, but also for credit approval, interpretability and justifiability is very important. I should be able to give a clear interpretation to my customers about why I am rejecting credit. Not only to my customers, but also to my banking regulators. Every country has banking regulators. Think about the Federal Reserve in the United States or the OCC in the United States, which carefully supervises the development of your credit risk models. Operational efficiency refers to how much effort is needed to evaluate, monitor, retrain the models. The average lifespan of a credit risk model is somewhere between 3 to 5 years, if you ask me, right? So those models will have to be continuously evaluated, back-tested, monitored to make sure that they still keep on performing satisfactorily, right? So that's part of the operational efficiency. Obviously, we also have the economical cost, and the economical cost refers to the cost that is needed to gather the model inputs and evaluate the model. And we can hereby further distinguish between total cost of ownership, which refers to the ownership costs of the analytical PD, LGD, and EAD models. And we can then also relate that to the return on investment, or in a banking setting, to the return on equity. Another aspect of another key requirement for your analytical models or regulatory compliance. Regulatory compliance refers to the extent to which your PD, LGD, and EAD models are in accordance with regulation and legislation. When I say that, I'm referring to the input side of the models and the output side, because the Basel Accords have clearly specified how the inputs of your analytical model should look like and what the outputs should be, right? So these are all very important model requirements which are situated at level 1 of your analytical models. Level 2 brings us into the model calibration activity. Level 1, where you develop your application and behavioral scorecards, for example, will provide you with discrimination. At level 1, we have a scoring facility, a facility which is going to rank order or entities or obligors using a score reflecting the likelihood of the event default occurring. We can rank order customers in terms of the likelihood of default. We can also rank order customers in terms of the losses that are likely to occur. Model discrimination is something that in traditional credit scoring we were very good at, hence the name scoring. Scoring means discriminating. But now, with the emergence of the Basel Accords, we need to move one step further and come up with calibrated probabilities. Remember, PD stands for probability of default. So we need well-calibrated and accurate projected probabilities. Probabilities which are accurately calibrated based upon historical data as well as based upon your expectations about the future. When I say expectations about the future, I am predominantly referring to the macroeconomic expectations, like, are we going to be faced with a downturn or with an upturn? That's really very important. The macroeconomic situation in many credit risk models these days is typically reflected by looking at GDP, gross domestic product, inflation, or unemployment. So bringing the macroeconomy into the model is really very important. You can see this illustrated here. To the left, we have a scorecard. This is a classical application scorecard as we would encounter it at level 1 of our credit risk model architecture. You can see some of you may note that it's slightly politically incorrect there because you see that females are less risky than males. Any real-life data set that you get, you will see that females are less risky than males. So in certain countries, we cannot discriminate based upon gender, and we would have to leave it out, obviously. But you can see the idea of the application scoring is to come up with scores. However, by adding the second level onto our risk model architecture, we also need model calibration. That means that we have to group obligors based upon them having similar scores into a rating. A rating like rating B, which is going to tell me what customers are similar in terms of their scores and hence in terms of their credit risk. And here you can then see the historical default rate for rating B. And from here onwards, we can then extrapolate towards the red curve in case we would assume a downturn situation, or the green curve in case we would assume an upturn situation, or the yellow curve which sits in between in case we assume, in case we make a neutral assumption. But this is based upon very advanced procedures for creating the ratings and doing the calibration. The creating of the ratings is typically something that you're going to do by clustering your analytical model outputs or your scores into pools. Note that a pool is a synonym here for a rating or a segment. For each of those pools, once we have defined them, and I cannot talk about ways to do this. In my e-learning course, I say a bit more about that, how you can do this using all kinds of heuristics or rules of thumb, etc. But once we have carefully defined our pools or ratings, we can then calibrate our event probabilities using forecasting techniques, using time series analysis techniques such as REMA. We can look at dynamic models such as Markov chains. We can do simulations, come up with projected macroeconomic scenarios, etc. And once we have our ratings, we can also see how volatile they are. We can actually have an idea about our rating philosophy, like do we have more of a point-in-time philosophy, whereby our ratings reflect default risk for one particular upcoming point in time, or do we have more of a through-the-cycle analytical model, whereby our ratings more adopt a more long-term time horizon towards assessing credit risk. That's very useful information, especially if you want to later backtest or monitor your analytical credit risk models. Here you can see our model architecture revisited once again. So remember, at level 0, we had the data. Level 1, we had discrimination. And what Basel II and Basel III brought along was that level 2, which is the calibration. Calibration means that we're going to come up with well-calibrated probabilities of default, whereby those probabilities of default are going to be carefully calibrated by introducing the macroeconomy, the effects of GDP, inflation, unemployment into our credit risk models. This is a very big challenge, if you ask me, in credit risk modeling. A side benefit of this multi-level model architecture is that we can very easily do stress testing. Because what's stress testing? Stress testing means that we're going to evaluate the potential impact on a firm of specific adverse events or movements in a set of financial variables. Basically, you can think of two types of stress testing. Sensitivity analysis means that you're going to analyze the sensitivity of your models to particular factors. Let's have a look back here at our multi-level model architecture. So I can do a sensitivity stress test at level 0. An example could be, in PD modeling, is that I assume that everybody's income drops by 10%. In LGD, I could stress test my LTV variable. LTV is a very important variable when you're building LGD models. It stands for loan to value. It's the exposure of the loan versus the value of the collateral, which is used to secure it. So if I would say all LTV values, because there's a real estate crisis, are going to increase by 10%, that could be an example of a data-driven sensitivity test. I can also do my sensitivity test here at the discrimination level. I can assume all my application and behavioral scores are going to drop by 10%. Or I can do my stress test right here at the calibration level by assuming that all PDs will increase by 5% by 10%, or that everybody's credit rating will drop with one notch, such that if you have a AAA rating, you drop to AA, if you have AA to single A, etc. Scenario analysis goes one step further. It's a little bit more of an advanced way to do stress testing because you're going to mimic the impact of a scenario. And those scenarios could be historical scenarios as you have witnessed them in your past portfolios or past population, or they could be hypothetical scenarios. Let's say sensitivities that you are aware you are exposed to and that you want to model as a scenario. Scenario is a set of factors that you will simultaneously assume to happen together. So a scenario could be here that you assume everybody's income drops by 10%, and at the same time, all loan-to-value ratios will increase by 15%. How would this affect the PDs, LGDs, and EADs, and so on? Stress testing, the first goal of stress testing is informative in the sense that you want to know how sensitive your expected, unexpected losses are with respect to adverse events happening. However, when you do stress testing, you're typically faced with various challenges, like you have a lack of historical data. Ideally, you want data on downturn situations, but you do not always have that available. You are faced with various risks that you need to integrate together in order to appropriately gauge their joint impact. You have to carefully define what is stress. If you define an adverse macroeconomic event, how adverse should it be? An example could be a 1 out of 25 years event. This is an event which is commonly considered to be an adverse economic event in the industry nowadays. The idea of stress testing is also to have an idea about model risk, because none of your analytical models are perfect, right? If you build a PD model, an LGD or an EAD model, it's always an approximation of reality, but it will never be perfect. As George Box put it in 1987, all models are wrong, but some are useful. And it basically, some models are very bad, and when I say very bad in credit risk modeling, I am predominantly talking about loss or LGD models. If you look at LGD models, and we've built quite a number of LGD models for banks worldwide, you often see that they have awful performance. And when I say awful performance, I'm talking of R squareds around 0.20. If you have an R squared of 0.30, that's already very exceptional. Remember, an R squared is a performance measure in regression which tells you how much of the variability in the target, LGD in this case, can be explained by your model. So predicting LGD, in contrast to predicting PD, as we already mentioned before, is a very challenging and difficult exercise. This is something we can complain about, but at the end of the day, there's not much we can do about it. It's just a very hard prediction task. So how can we deal with model imperfection? Well, from a credit risk perspective, we can deal with model imperfection by doing conservative parameter calibration. Conservative parameter calibration means that instead of using an LGD of 20% as it comes out of our models, we're going to put it to 30% to make sure that we're on the safe side, to make sure as a bank that we are well protected. Put differently, basically what we're saying here is that it's better to overestimate risk because then we're safe, we have enough buffer capital, than to underestimate risk because then we can go bankrupt. Very important in this conservative parameter calibration is, of course, how conservative should one be? Because at the end, we can put everybody's LGD to 100% and then we're extremely conservative. But this is going to weigh pretty hard on our return to equity measures. So that's also not something that we want. So you have to kind of carefully decide upon the margin of conservatism that you want to adopt there. This is all part of model risk. It's basically to deal with the problem that models are often not perfect. That brings me to a next activity, which is model monitoring. Our PD, LGD, and EAD models only have a limited validity range, right? That means that they're not gonna keep on working optimal for long periods of time. We will have to continuously monitor our analytical PD, LGD, and EAD models to make sure that we can diagnose when they start degrading in performance. Before we work out this exercise, we have to wonder why analytical models can degrade in performance. Analytical models can degrade in performance because of various reasons, because of sample effect. So sample effect states that analytical models were built using a limited sample. And every sample, as I already mentioned before, has its bias, has its limitations. And as soon as you start summarizing a sample's behavior in terms of PD, LGD, and EAD, the numbers that you get always come with variability. That's the variability due to sample effects. But we can also have macroeconomic effects. Macroeconomic effects mean that we have effects because of macroeconomic downturns, stress situations, etc. We can also have endogenous effects as they are imposed because of strategy changes, population drift, merger acquisitions, and so on. Now, the reality learns that usually we have a mix of all these effects, which seriously complicates our model monitoring exercise. Nevertheless, the model monitoring exercise is really crucial because the model outputs are going to directly serve to calculate or expected losses and our capital buffers. So we better make sure that we have appropriate model monitoring facilities put in place. We can hereby make a distinction between quantitative and qualitative validation. I cannot get into much detail on this, but quantitative validation means backtesting, and backtesting says that you're going to contrast your model output with the realized output. If I have a rating B, and I say 5% of those obligors are likely to go into default, and it turns out to be 8%, then comparing the 8% with the 5% is what we refer to as backtesting. Benchmarking means that you want to make sure that your model is good, so you come up with a benchmark. A benchmark is a reference model that you use to actually compare your first model against. Qualitative validation is not based upon data and numbers, but it's based upon looking at data quality, seeing how you can remedy issues with data accuracy, with data completeness, etc. It's also looking at model design, like who designed the model, what's the scope or validity of the model, what are the counterparties that can be scored by the model, etc. It also focuses on documentation, corporate governance, and management oversight. So corporate governance and management oversight refers to the involvement of senior management and the board of directors in the whole model development, validation, and stress testing process. Backtesting, as already mentioned, contrasts ex post realized numbers, estimated PDs with ex ante, or realized PDs with ex ante PDs. There's basically a plethora of statistical tests that you can use for this purpose, like the binomial test, the Hosmer-Lemeshow test, the Vasicek one-factor test. We don't have time to discuss it in this course, but each of these tests has their own pros and cons. Each of them have their specific advantages and disadvantages, and it's really important that you know which one you should apply when. Not only which one you should apply when, but also what confidence levels we should adopt. Because as soon as you adopt a statistical test, you need to decide, are we going to use a 95% confidence level, a 99% confidence level, and so on. Here you can see some backtesting examples. These are just some screenshots which I took out of my e-learning course, where we can backtest data stability. Data stability is something that you typically backtest at level 0 to see whether your data has remained stable, yes, or in time, or whether you have what we call population drift, whereby your population starts drifting according to certain characteristics. Or you can look at the discrimination power as it is expressed by means of an accuracy ratio, which is a very important performance measure at level 1 of your analytical models. Backtesting and benchmarking, or validation as such, will allow you to determine whether your models are still okay, yes or not. And if your models are still okay, then you can continue using them. But if they're not okay, you basically have to do something. You have to remedy the situation. That's why we need action plans. Action plans are going to tell us what to do in response to what finding. So if the model calibration is okay, obviously we can continue to use our model. If the model calibration is not okay, then we have to go down one level, up to level 1, and look at the model discrimination. If this is still okay, then it means that we can simply recalibrate the model. Increase all PDs with a fixed percentage, or maybe even decrease them, depending upon the situation, and then the problem may get fixed. If the model calibration is not okay, we have to go down to the deepest level into our model architecture and verify data stability. If this is still okay, I can look for model tweaks, although I have to admit that this is not that easy, and usually it will boil down to a complete re-estimation of the model, as you can see right here. Good. In this very short, before we move on to the demo, what are the lessons we have learned thus far? So thus far, we have learned that the best way to improve the performance of an analytical model is to improve data quality first. And remember, data quality is a multidimensional concept. It consists out of data accuracy, data completeness, data consistency, data bias, data recency, etc. A good analytical model does more than giving good statistical performance. It should also be interpretable, it should be justifiable, it should come at low economical cost, it should be regulatory compliant, and it should be operationally efficient. We also zoomed into the difference between discrimination versus calibration, whereby we strongly advocated the idea of bringing the macroeconomy into the model. We zoomed into the concept of model risk and discussed the need for model validation and action plans. Okay, so what I'm going to do now is I would like to give you a very small demo of a course which I have developed together with SAS, on all these concepts, credit risk modeling. Now, some of you may wonder, why did you develop it together with SAS? The software course, but the course focuses on the modeling concepts and modeling steps. We have occasionally also demos with SAS, but this is not the core part of the course. 80% of my course focuses on the concepts, on the various ways to model PD, LGD, EAD, to validate and to stress test them. So my course is definitely not a software course, and I will show you why. So I will log on to the SAS website where you can get the course. I already tell you, the course is not a free course, unfortunately. The reason it's not free is because we spent 4 mad months developing it, and it's based upon about 15 years of industry and research experience, right? So we could definitely, given all the resources that we have spent into this, we could definitely not do that for free. Okay, so now let me show you, hang on, first go to the website. Come on. Go to my training, and now I should have access. So here you can see, upon registration to the course, you will get a link like this, Credit Risk Modeling Using SAS. And this is a self-paced e-learning course. Upon registration, you will get 1 year access to all course material. And the course material consists of about more than 20 hours of videos explaining all the concepts. So I can do Start Course. And here you can see, you can play each of the videos as many times as you want. Here you can see all the lessons. So we have an introduction to credit scoring, the Basel Capital Accords, including Basel 1, Basel 2, Basel 3, etc. We have preparing the data, whereby we're going to zoom into outlier detection, missing values, scores classification techniques which are used, such as logistic regression, etc. We have a whole lesson on measuring the performance of credit scoring models using receiver operating characteristic curves and so on. Each of these lessons consists of video. So I go to receiver operating characteristic curve, and here you can see the receiver operating characteristic curve. You can hear audio playing. I'm not sure whether you're going to hear the audio play because I'm now using my audio to do this webinar, but this comes with audio, right? And it's also subtitled. Here you can see the subtitles. So this video, for example, is going to teach you step by step how to build a receiver operating characteristic or ROC curve. You can fast forward wind if you want. You can see the whole video. This is a video of 2 minutes which explains you the whole idea. You can also find the text behind the video, so you can see the text that comes with the video in case you want to read it at your own pace. The video also comes with questions to make sure that you understood everything correctly. These are multiple choice questions, so you can highlight the answer and then see whether it's correct, yes or no. You get some feedback. At the end of every lesson, you have a quiz, and the quiz is basically, 5 to 10 questions to make sure that you got everything correctly, right? You can do the quiz as many times as you like. And obviously, as I told you, you have 1 year of access to this course material. Besides focusing on PD, basically we also have lessons on LGD modeling, right, whereby we explain the whole trajectory to constructing an LGD data set, creating an LGD model, and defining ratings and calibrating an LGD model. You can see that the course is not software specific because these are all, conceptual sessions we have. Occasionally, we also have demos in SAS, but I can tell you that almost half of the people that registered for my course are not SAS users. But in case you would be interested to see things in SAS, you can also have demos and see how you can do LGD modeling in Baesens, for example, right? The software we use, the SAS software we use for demos is Baesens as well as SAS Enterprise Miner in case you're interested. But again, this is not essential for this course. It also comes with sessions on validating models and a very specific section on low default portfolios, which is an issue that is bothering many financial institutions nowadays. We also have a help and resource section where you can have the data sets. You can download them onto your machines. You can also have a course certificate. Upon completion of the course, and the system kind of tracks once you have completed it, you can print out a course certificate saying that you have followed the course. Okay, so it's pretty successful right now worldwide. We have quite a number of people that already took it. If you would have more information about it, feel free to let me know. You can find everything on this website right here. If you would just click this reference, you can find it there. If you cannot find it, let me know, and I'm more than happy to assist you to it. This is one self-paced e-learning course I have. I have another one as well, which is entitled Advanced Analytics in a Big Data World. If you'd be interested in the more general concepts of advanced analytics, such as social networks, such as neural networks, such as survival analysis, I also have another one which is quite similar in terms of setup, which addresses those issues in a self-paced e-learning format. So again, very important to note is that you'll get it's not like you play it and then it's done. You will get 1 year or 365 days access to all course material. Okay? Good. I think I'm more or less ready to wrap up. You can see some further references. You can find the material. You can find a lot of material on my website as well, which is dataminingapps.com, including some resources, some references, etc. Okay, Emma, I don't know whether we have time for some questions.
Yes, we do. So if anybody would either like to shout out or write something in the chat box.
Emma, I can't hear you.
No, okay. Yes, we do.
Do we have time for questions? If anyone has a question, you can send it to me by text, or you can enter the phone conversation. So we have time for questions. That's awesome. So if you can step into the phone conversation in some way, or you would like to send it to me as a chat message, that's fine.
Hello, Bart.
Hello there.
It's Andrew here.
Hey, Andrew.
I've got one question.
There's some echo on the line, so
the countries that we operate in, data quality is a real issue.
Yep.
Can you give us some advice on what we should do when we start to develop models in countries where we know the data quality is an issue? but a model is better than no model at all.
That's right. Okay, if you know, so maybe you can switch off your, because we have a tremendous amount of echo right here. So the question was, if we develop models and data quality is an issue, how should we tackle this, knowing that that we need a model, and a model is better than no model at all? I think you should first carefully diagnose the data quality a little bit more specific and see whether it's a data completeness or a data accuracy problem. Most of the times, it's either a data accuracy or a data completeness problem. If it's a data accuracy problem, you have all kinds of procedures that you can use. There's some echo, and maybe you want to switch off if you switch off your microphone right now. If you mute your microphone, it will. Yep, great, thanks. So the data accuracy problem is something that you can remedy by, one, making sure that you have appropriate techniques to diagnose data accuracy issues. And there exists a whole set of statistical tools like box plots that you can use for this to detect univariate outliers. There exist ways to detect multivariate outliers using clustering procedures and so on. So once you've diagnosed that, you can start remedying those outliers by using outlier handling methods, for example. If it's a missing data problem, then you have to have a close look at why is the data missing. Is it missing at random, which is not that much of a problem, or is it missing not at random, which is a more severe problem? So before you start developing your models, you have to dig down into your data, and what I would do is I would look at data accuracy, look at outliers that you have in your data, unusual values, using any of the statistical tools we have available, and then treating them afterwards, and then followed by looking at data completeness and seeing whether you have, whether you're missing values or missing at random, yes or no. And depending upon the outcome of those two steps, depending upon the way you have been able to deal with both issues, you can then start developing models. And those are models, if you would say, like, look, I have missing values and I cannot do much about them, there exist models that can perfectly cope with missing values. One of those models, for example, is decision trees. Decision trees are an example of a technique that can perfectly deal with missing values because they will just assign all missing values one branch in the tree. Okay?
Thanks, Bart. That's appreciated.
Pleasure. Any other questions? Okay, we're gonna do a contest. The first two questions I get next will get a free copy of any of my books. But I need two questions. If anyone asks me a question right now, the first two questions I get. Unless no one wants a copy. Okay, AJ, thanks. AJ asked me a question. I got two questions in the chat box, right? So AJ, let's see if I got two questions. Hey, now the questions start entering in. Hang on. So I see. Okay, so I get Nikolov. It's the first question I got. So Nikolov asked me, do you apply reject inference in the application PD stage, and what approaches are best practice? Yes, reject inference is a very hard problem. It refers to the fact that when you develop application scorecards, you do not have information upon your rejected population, which may introduce a bias into your risk models. There's just a couple of ways that we also discuss in the course, like hard cutoff augmentation, fuzzy augmentation, and parceling. The best way, I think, to deal with reject inference is by using a credit bureau. Maybe an organization like Creditinfo, whereby you look at your historical set of rejects and ask the credit bureau to actually label them. Either the privacy regulation allows you in your country to label those as good or bad, depending upon whether they get loans elsewhere. If not, you can also look at default rates as they are provided by the credit bureau and look at the default rate in your reject population and use that in combination with a hard cutoff augmentation method, for example. So summarizing, I always like to solve reject inference problems by making use of credit bureau information. It has the extra information you need to understand the bias in your reject population. I think that's very important. Nikolov, you asked me a question, so you can send me an email afterwards with your postal address and I'll send you a copy of my book. AJ, you're the next one. Could you recommend any statistics books that may help? Well, I can recommend my book on analytics in a big data world, but if you want a pure statistics book, the best statistics book, but it's not that easy to read, but it's a book called Elements of Statistical Learning. Elements of Statistical Learning, written by Friedman and Tibshirani. Jerry Friedman and Tibshirani. Elements of Statistical Learning. This is the best book, but it's not that straightforward to read. It's not something you're going to read lying in the couch and watching television and meanwhile reading the book. It's a pretty complex book. You apply, reject. How best to calibrate a score model upwards? That question from Brookney, I don't understand very much. Well, I think I got it. How to add the margin of conservatism. Well, for LGD, there have been some mapping formulas that have been introduced to do so. If you look for LGD, for example, the US regulators introduced a mapping formula whereby the LGD that comes out of your model was transformed as follows: 8% plus 92% times the LGD out of your model. So there are some mapping formulas that are being used in the industry for LGD and PD separately that you may want to have a look at. For LGD, look at what the American regulators have introduced 2 or 3 years ago. And for PD, you can map it upwards by making use of the Vasicek model, which is also underlying the Basel Accord. The Vasicek model is basically a value at risk approach, which basically maps your PD upwards by adopting a 99.9% value at risk approach. Okay, so, Bart, need your crystal, so Anand, Bart, I need your crystal ball. Well, my crystal ball. Where do you think modeling is going? How to prepare for the future? Well, that's a kind of generic question because it largely depends upon the settings you work in. But I think the modeling is going to become more and more sophisticated. Right now, the models which are, in credit risk modeling, the models are pretty sophisticated when you compare it to other areas like marketing, fraud, or HR analytics, for example. In credit risk and insurance, you see the most sophisticated models. Why? That's pretty obvious because of the regulatory compliance. We don't have regulatory compliance in marketing, fraud, or HR, so the models are a lot less well developed. I think modeling is going to become more and more sophisticated. One of those techniques that I strongly believe in is, for example, survival analysis. Survival analysis is a very important set of techniques with a lot of potential. Most credit risk models now predict if a customer will be a defaulter, yes or no. Survival analysis take it one step further and also add the timing dimension. They will also add when are customers likely to default. And I think survival analysis will become very important. That's one of the topics which I also discussed in my other e-learning course, in case you would be interested. AJ, Emma. Okay, so I think I got, that's it, right? So any other questions, guys? So you have quite a bit still on the line. Any question you'd be interested in, please feel free to ask. Thanks, Nicola. Thanks for the kind words. Appreciate it. So again, I would like to, no more questions? Everybody's okay? I would like to thank you for attending this webinar. Remember, what we did was I went through some of our recent research findings related to modeling, validating, and stress testing PD-LGD and EAD models, and then I ended with a demo of my e-learning self-paced credit risk modeling course. In case you'd be interested in any information about the presentation or the course, let me know. And thank you for attending this webinar. Thanks very much.
Well, thank you very much for your time. And can you hear me now?
Yeah. Yep. There's one more thing, Nikolai. I see that you added it added your address in the chat box. Please send it to me by email. If you Google my name, you'll find my email address. So please send it to me by email. Thank you. Yep. Emma, I'm done right now. Okay. Thanks, everybody. Bye-bye. I'm disconnecting now. Take care.
Thanks, Bart.